If you had $10,000 right now, would you put it into a rental property, or would you put it into the stock market? This is one of the biggest debates in personal finance, and honestly, there's no shortage of people online who will tell you with complete confidence that one is obviously better than the other. Real estate guys will tell you stocks are a gamble. Stock market guys will tell you real estate is a headache with a mortgage attached. The truth, as usual, is more interesting than either extreme. In the next 20 minutes, I'm going to walk you through the real numbers, the real risks, and the real lifestyle trade-offs of both. By the end, you won't just know which one performs better on paper. You'll know which one actually fits your life, your risk tolerance, and your bank account. So grab a coffee, get comfortable, and let's break this down properly. Before we get into the comparison, let's talk about why this conversation is more relevant today than it's ever been. Mortgage rates have swung wildly over the past few years. Home prices in a lot of major metro areas are still sitting near record highs, even after some cooling off. At the same time, the stock market has been on one of its more turbulent rides, bouncing between record highs and sharp corrections. For the average American trying to build wealth, this creates real confusion. Do you save up for a down payment while rent eats into your budget, or do you skip homeownership for now and just dump money into an index fund? These aren't just abstract questions, they determine how comfortable your retirement looks, how much flexibility you have in your career, and honestly, how much stress you carry day to day. And here's the thing nobody tells you, this isn't actually an either-or decision for most people. It's a question of sequencing, proportion, and personal circumstances. So let's get into the actual data. Let's start with the numbers, because this is where most of the internet arguments go wrong. Over the last roughly 100 years, the U.S. stock market, specifically something like the S&P 500, has returned an average of about 10% per year before inflation. After you adjust for inflation, you're looking at something closer to 7% annually. That's the number most financial planners use when they're building long-term projections. Residential real estate, on the other hand, has historically appreciated at a much more modest rate, somewhere around 3 to 5% per year nationally, again before inflation. Some hot markets outperform this dramatically over certain stretches, and some markets barely keep pace with inflation at all. Now, if you just stopped the conversation here, it would look like stocks win, hands down. But this comparison is misleading, and here's why. Real estate returns quoted this way usually only reflect price appreciation. They don't include rental income, and they don't include the impact of leverage. Stock market returns usually don't include the cost of the capital you used to buy in, because most people buy stocks with cash, not loans. So to really compare these fairly, we need to look at total return, not just price movement. That means factoring in dividends for stocks, and rental income plus leverage for real estate. Let's do that next. This is the part most people misunderstand, so pay close attention. Say you buy a $400,000 house with a 20% down payment. That means you're putting $80,000 of your own cash in, and borrowing the other $320,000 from the bank. If that house appreciates by 5% in a year, that's a $20,000 increase in value. But you only put in $80,000 of your own money. So your actual return on your cash investment is $20,000 divided by $80,000, which is 25%. That's the power of leverage. Compare that to stocks. If you invest $80,000 in an index fund and it goes up 10%, you've made $8,000. That's a 10% return on your money, full stop, because You didn't borrow anything to buy those shares. So on the surface, leverage makes real estate look incredibly attractive. And this is critical, leverage cuts both ways. If that same house drops 5% in value, you've lost $20,000 on an $80,000 investment. That's a 25% loss. Leverage amplifies gains, and it amplifies losses just as violently. This is exactly what happened to millions of homeowners during the 2008 financial crisis. People weren't just losing value in their homes because of leverage, many of them lost their entire down payment and then some. Stocks can be leveraged too, through margin trading, but the vast majority of everyday investors don't do this, and honestly, most financial advisors would tell you not to. So when you hear someone say, real estate returns beat the stock market, ask them, are we talking about leveraged returns or unleveraged returns? It's not an apples to apples comparison unless that's clarified. Now let's talk about something that doesn't show up in return calculations but massively affects your quality of life: liquidity. If you own stocks and you need cash tomorrow, you sell your shares and the money is typically in your account within a couple of business days. It's fast, it's simple, and the transaction cost is often close to zero. If you're using a modern brokerage, real estate is the opposite. If you need to sell a house quickly, you're looking at weeks or months, realtor commissions that typically run 5 to 6% of the sale price, closing costs, potential repairs to make the house market ready, and the very real possibility that you have to sell below market value just to move fast. This lack of liquidity is one of the biggest hidden risks of real estate investing. Your money is locked up, and unlocking it isn't free or fast. There are also ongoing costs with real estate that people underestimate. Constantly. Property taxes. Homeowners insurance, which has gotten dramatically more expensive in states like Florida and California due to climate-related risks. Maintenance and repairs as a rule of thumb. Many experts suggest budgeting 1 to 2% of your home's value every year just for upkeep. If you're renting the property out, you've also got property management fees, vacancy periods where you're paying the mortgage with no rental income coming in, and the emotional and time cost of dealing with tenants. Stocks, by comparison, are almost maintenance-free. You don't get a call at midnight because the index fund has a leaky faucet. Taxes are a huge part of this conversation, and the U.S. tax code actually treats these two asset classes quite differently. For real estate, if it's your primary residence, you get a significant tax benefit when you sell. Under current law, single filers can exclude up to $250,000 of capital gains, and married couples filing jointly can exclude up to $500,000. As long as you've lived in the home for at least 2 of the last 5 years. That's an enormous benefit that doesn't exist for stock market gains on your primary investments. If it's a rental property, you can deduct mortgage interest, property taxes, insurance, maintenance, and you can also use depreciation to offset your taxable rental income, which is one of the most powerful tools real estate investors use. For stocks, if you hold your investments for more than a year before selling, you qualify for long-term capital gains tax rates, which are generally more favorable than ordinary income tax rates. And if you're investing through retirement accounts like a 401k or a Roth IRA, your gains can grow tax-deferred or even completely tax-free, depending on the account type. Neither asset class has a clear tax advantage over the other in every situation. It really depends on your income level, your filing status, and how you're holding the investment. This is genuinely a case where talking to a tax professional about your specific situation makes a real difference. Let's talk about risk, because return numbers mean nothing without understanding the risk you're taking to get them. Stocks are volatile day to day. You can log into your brokerage app and see your portfolio down 8% in a single afternoon. That volatility is uncomfortable, and it causes a lot of people to panic sell at exactly the wrong time, locking in losses that would have recovered if they'd just stayed invested. Real estate doesn't show you that volatility in real time, because there's no ticker updating the price of your house every second. This gives people a false sense of stability. Your house could be losing value just as fast as a stock portfolio during a downturn. You just don't see it happening in real time, so it feels calmer even when it isn't. There's also the diversification question. With a few $100s, you can buy a broad market index fund and own a tiny slice of 500 different companies across every major industry. With real estate, unless you're buying into a REIT, which is a real estate investment trust that trades like a stock, most people's real estate exposure is concentrated in one property, in one neighborhood, in one city. That's a significant concentration of risk. If that local job market collapses, or a natural disaster hits that specific region, your entire investment is exposed with no offsetting diversification. Here's the honest answer: for most people, this isn't a competition. It's a combination. If you're planning to live in a home for at least 5 to 7 years, buying can make a lot of sense, because you get the tax benefits, the forced savings of paying down a mortgage, and you eliminate the risk of rising rents. But buying a home purely as a short-term investment, hoping to flip it for profit in a year or two, is a much riskier bet than most people realize once you factor in transaction costs. For building long-term wealth, especially through retirement accounts, the stock market's combination of liquidity, low costs, and historical returns makes it very hard to beat for most individual investors, particularly through simple, low-cost If you want real estate exposure without the headaches of being a landlord, REITs let you invest in real estate through the stock market itself, getting some of the income and appreciation benefits with the same liquidity as a regular stock. The people who build the most wealth over time usually aren't choosing one over the other exclusively. They own a home for stability and tax benefits, they invest consistently in the stock market for growth, and, depending on their risk appetite, they might add rental properties or REITs on top of that as their portfolio grows. So, real estate versus the stock market, it was never really a fight to the death. It's about understanding what each one is good at, what it costs you in time and flexibility, and how it fits into the bigger picture of your financial goals. If you found this breakdown helpful, hit subscribe, because we're going deeper into personal finance and investing strategy every week on this channel. Drop a comment and let me know, are you team real estate, team stock market, or team both? I read every comment, and I'll see you in the next video.